Okay, so in this example, I want to wrap up our 12/31/2023 financial statements. So if you're in the Tuesday, Thursday section, we ran out of time before we got to the end of the 12/31/23 financial statements. So here's what we've got. Balance sheet, by the end of 12/31/2023, we have totally paid off the bond. We have no more discount, no more bond payable, no nothing. And so this is all just going to show up as zeros. Income statement, how much interest expense do we show? We've made our 3/1/23 entry of $9,817 and our 9/1/23 entry of $29,717. I think I'm $1 or $2 off. Bear with me, ignore the rounding, please. So our interest expense is $39,534 for the year. So it's going to be recorded there. In our statement of cash flows, we are going to record the repayment of the bonds. This is going to be in our financing section of our statement of cash flows. We record the payment of $500,000. It's a cash outflow. We're also going to record cash payments for interest of $50,000 because we've done our March 23 and our September 23 payments, both of those made during the year 2023. We're also going to record our decrease in the interest payable. Excuse me, you'll remember we increased interest payable from 0 to $16,667 during 2020. 2021 and 2022, both of those years started and ended with $16,667, so there's no change in the interest payable. 2023, we would have started with $16,667. That was carried over from our 22 accrual, but now we are reducing interest payable because we're paying off that last amount. The bond is completely paid off. And so the ending balance on our interest payable is 0. And so our interest payable decreased from $16,667 down to 0. It's a decrease in a current liability that shows up as a cash outflow in our operating section. Cash flowed that we didn't have an expense for, at least during 2023. And then in the last piece, the amortization of the discount on bonds payable. So I've got all the 4 years worth of bonds payable amortization entries color coded for you. So remember what's going on with the discount. So the discount, we have a discount because we have more interest expense than the cash flows we're going to make. So for example, in this, at September 1st, 2021, we made a cash payment of $25,000, but our interest expense was $28,736. What that means is interest expense is higher than cash flows, so our net income is lower than the cash outflow from operating activities. And so we want to add back that difference, that $37.36 difference. We're going to add that back to get to cash flows from operating activities, just like depreciation expense. Well, so $56.75 is the number we had for 2020. $75.51 is the sum of the 3 credits to the discount account for 2021. For 2022, our total amortization was $84.85, and then for 2023, we just had, again, the 2 entries, the March and the September, because we don't have a December entry, and our total amortization of the discount on bonds payable is $6,199, again, within $1 or $2 of rounding. And so all of these things are what's going to show up, all of these are going to be what shows up in our December 31st, 2023 financial statements. Thanks for watching.